Welcome to the bear trap. You just fell into the bear trap. We have 3 videos to react to in this one here today on the reaction channel, and all 3 of them bearish. Okay, first one up here we're going to react to. We're going to have a significant economic slowdown in the next 12 months. I want to hear what that woman has to say and kind of give my perspectives and opinions on that one. Then I want to react to this one from David Rosenberg. High rates will lead to a consumer-led recession more severe than people think. I want to hear what he has to say, react to that one. And last one up here from Jeff from 6 hours ago. We still expect a recession later this year or early 2024. So, the reason I wanted to knock out 3 bearish videos all together here today is I want to hear, are these the same talking points that each one of these bears is giving? Do any of them give, let's call it an insight that maybe we're not looking at right now? And so I think it's a really, really important to kind of, hear these folks out. I think it's a much better time to listen to bears right now than it was 9 months ago, right? Because everybody and their grandma was bearish 9 months ago, certainly, right? And you could hear the bearish talking points anywhere 9 months ago. And now, obviously, the markets have been doing very, very well. We don't have the recession as of right now, right? And so I think it's actually a more appealing time to actually hear kind of the other side and see, what do we have out there for risk. So hope you enjoyed today's video. As always, I appreciate everybody joining me. Thanks so much for being subscribed, folks. We are at, I don't even know, 33,000 plus subscribers now. It's a new all-time high. I appreciate every single person for being subscribed. And also thank you everybody that follows me on IG. If you ever want to send me a DM on there and say hello, let me know you enjoy the channel. Check out the pinned comment down there. You can follow me on IG. Let's get into this.
Could it be a risk to equities? Well, certainly our next guest thinks so. Joining us is Neuberger Berman Private Wealth Managing Director Holly Newman Croft. Holly's team manages more than $3.5 billion in assets, is ranked by Barron's as one of the top financial advisors in this country. Welcome back, Holly.
Thank you. Good to be here.
So more others are following your negative footsteps. You have said to be cautious pretty much all year.
Yeah, actually going back into last year. No, nothing's changed, but it's sort of refreshing to be here on a down day finally. It seems like maybe market sentiment is trying to catch up with all the leading indicators, which have been negative for quite some time. And I've been bearish, as you know, for quite some time. But I think what's happened this year is the market hooked on to inflation coming down, and they just let the market run with that. But now it's hard to ignore some of these leading indicators. The yield curve has been significantly inverted for 12 months, and as you know, a recession typically comes 15 to 18 months after that inversion. We're seeing contraction in the market. PMI surveys are below 50.
Yeah, so the scary thing about the whole yield curve inversion, right? There's actually 2 parts that are actually really, really scary in regards to that, right? The first one is it's been inverted for quite some time now, right? She just said 12 months or so. That's a scary sign that it's been this long. The second component that's even more scary, in my opinion, in regards to the yield curve inversion is we are in a situation right now where the yield curve is about the most inverted you've ever seen it before, certainly in any time in modern history. And so those 2 factors together definitely make it a little scary, especially for 2024, that eventually this stuff is going to hit the fan, as they say.
And as you may have read recently in the Wall Street Journal, there was an article that some of the major consulting firms are actually delaying the start of their recent college and MBA hires 6 to 12 months, which suggests that they're seeing a decrease in demand for their services. So
is your primary worry now a recession, or is it that the Fed is just going to have to keep fighting the inflation?
Well,
or both?
I think the Fed is at or near the end of the hike cycle. This is the most aggressive cycle that we've seen in years. And I don't think it matters if we just have a slowdown or we have a recession. I sort of think that that's irrelevant. What I do think is our 12-month outlook at NB Private Wealth is that we're going to have a significant economic slowdown and that the market is going to catch up to the indicators that have been signaling this for quite some time. So my concern is and has been to protect our clients and their portfolios in the face of what we expect to be a downturn.
certainly you don't believe earnings are going to come in to fill what's happened to multiples lately.
I don't. I think, we talked about inflation coming down, but if you look at wage inflation, that has been unbelievably high, at multi-decades high, and that's putting pressure on all of the companies and on their profit margins. So it's going to take months for the tightening to work its way through the system and for us to understand and feel the impact of the tightening. We're just starting to see it now. We're just on the cusp.
That said, though, a lot of people still say the number one wage dynamic is growth in real wages and purchasing power that will drive retail sales, which is most of our economy. Does that not make sense?
Well, as we just heard, we're starting to see car loan defaults, and I think there's still surplus money in the system left over from the pandemic, and that is not evaporated, but it is declining. And where we're seeing a lot of labor market shortage is not in the older population or people near retirement, but it's in the younger college graduate age group. So they might have had surplus money to drive what they're buying and what they want, but that surplus is running out. So I think it's just catching up with us. We've been on this euphoria driven by AI, driven by our labor markets, and it's almost a case of, is good news, the strong labor market, becoming bad news? And is the wage inflation putting pressure on the Fed to have to keep rates higher for longer?
Yeah, and you might think that it's a good thing that the Fed's almost done raising rates, right? And that is somewhat of a good thing. But the bad news is, usually when the Fed starts cutting rates, the scary part is usually you're in a major market downturn where stocks are getting obliterated and where unemployment's climbing quite significantly. So usually you're okay as long as they're raising rates or kind of keeping rates there. But once they start cutting, it's usually a bad signal. And so that's a tough situation. Is we, at some point in time, interest rates being as high as they are, it's going to hit the economy. It's just a matter of when does it finally let the Fed lags catch up and it really starts to hit, right? And then everybody's like, oh man, this is actually having a really, really negative effect. My guess is at some point in 2024, right? And so when that happens, then the Fed can say, okay, things are starting to get hit bad. Let's start cutting rates. Usually by that time, it's too little, too late. And you're already in the dominoes rolling the wrong way, and it gets quite a bit worse for quite a while. And then eventually you kind of bottom out there and then come up to the other side, and then you can form a longer-term bull cycle, a longer-term employment cycle, a longer-term, just prosperous kind of cycle there. But unfortunately, you have to go through quite a bit of pain to kind of get to that other side. So that's something we do have to be aware of, and I think it's important, especially if you haven't been in the market a while, you are aware of that. Okay. Next one up here: high rates will lead to a consumer-led recession more severe than people think, says David Rosenberg.
Let's bring in David Rosenberg, founder and president of Rosenberg Research. David, great to have you with us. You say it's silly season these days for the equity markets. Why is that?
Well, I think it goes back to the comment that was just made about valuations. So I understand the momentum aspect of this market and the technical aspect of it, and we could debate the soft landing or hard landing. I would say that even if you have a soft landing or no landing view, let's face facts. You have a 20 multiple on the S&P 500 on forward earnings. That's a 5% earnings yield, and you can pick up 5.5% in the treasury bill market with no cyclical risk, no duration risk, no capital risk. So I would say that, when you do the math, it's a very expensive market, no matter what your macro view is. And so when I'm talking about silly season, it's one thing to have.
So you might think I disagree with this gentleman. I 100% agree with him. I think it is an expensive market. I think there's few opportunities out there. I think it's a stock picker's market right now. I think to just be buying S&P 500 straight up, I don't think it's a very intelligent decision at the moment. I think there's a lot of stocks out there. And when I say a lot, I'm talking like 10 to maybe 15 stocks that are great opportunities right now. Value stocks, dividend stocks, and some growth stocks out there. But I don't think this is just a easy, S&P 500, I'm getting a great deal. No, you're not. You're getting a pretty poor deal right now if you're buying just S&P 500. As he just explained there, the risk reward is not on your side if you're just buying the S&P 500 straight up. And I think that's an important factor that people have to understand, and especially considering the potential downside risk of if we do actually have a major recession of some kind or unemployment was to go up in a significant way, obviously that's going to hit S&P 500 earnings considerably, right, across the board. And so if that's the situation, you're actually getting ripped off buying the S&P 500 right now. And so I'm 100% in agreement. It is it's an expensive market. It's one of the more expensive markets I've ever seen outside of maybe late 2021. But you could make an argument that this market is more expensive. If you're buying, let's say you were buying the S&P 500 at the end of 2021, or you're buying the S&P 500 right now. I can make an argument that it's more expensive right now based upon where interest rates were then at 0 and where Fed funds rate is right now, 5% plus, and the fact that you can get 5% plus, basically guaranteed money in treasuries. So even savings accounts are yielding 4.5 right now, right? Versus taking that risk in the S&P 500 at very high valuations right now. So yeah, I pretty much agree with him.
Multiple a couple of years ago when rates were at 0. But today, the equity risk premium has only been where it is today, less than 10% of the time in the past. So the valuations are extreme. I'm not going to say that they are dot-com level extremes, but we are in the top 10% of valuation excess that we've had historically, and I think that's a warning sign.
I agree with that.
How do you see this playing out then? It does seem like so many people are all of a sudden, moving to the other side of the boat, so to speak, in terms of soft landing scenario, no landing scenario. They're jumping on board. We see strategists bumping up their price targets for the S&P 500 by year end. I mean, it just seems that all of a sudden everybody's getting really bullish just when you say silly season is starting.
Well, I guess it's the benefit of having done this for 40 years. So you see what happens is that the market takes off for whatever reason. And then you get the analysts and the economists and the strategists then scurrying around trying to fit the narrative into the price action. Sometimes the stock market's going to do what it's going to do. We go back to 2007, for example. I mean, nobody really had a recession in their forecast, and everybody was talking about, where's the recession? We had the inverted yield curve. The lags are extremely long. As we had back then, as we had...
I was doing some study of the Fed lags over this weekend especially, and what I found was usually from the time the Fed starts hiking rates in a substantial way, usually it's 1 to 3 years until it really hits the stock market in a major way and the economy in a major way. So it's obviously been about a year, and we can call it probably a year and a half since the Fed started all of a sudden hiking rates, boom, 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 right? So likely we should see something happen probably within the next 6 to 12 months in terms of Fed lags catch up. It really hits the market hard. It really hits the economy hard. We should see that. Doesn't mean it's guaranteed, though. Nothing in the finance space is ever 100% guaranteed. But just based upon history, based upon how this stuff usually works, we should probably see something happen within the next, I would say, 6 to 12 months here. And that's going to be an interesting moment.
Today, we had a very expensive market on our hands. And at the same time, we had a ripping rally, from the summertime of 2007 to the October 9th high. The market absolutely ripped. And everybody's scratching their heads. Of course, we know what happened next. And so sometimes people just fit the narrative to the price action, because what else are you going to do? But we all know that the market is this malevolent beast, does not always respond to valuations. It's not a timing tool. It doesn't always respond to the fundamentals. It just sometimes takes a head of its own, and it's called animal spirits. The reason why the term animal spirits is around is because that's what happens when we have a momentum-based rally, which we've had for the past several months. I mean, the one thing I would like to ask the group is this, that when the Fed is cutting interest rates into a bear market, all you ever hear is, don't fight the Fed, don't fight the Fed, don't fight the Fed. And valuations matter. The market's cheap. But on the other side of the coin, the Fed is tightening policy, and they really haven't signaled that they're done yet. You don't hear anybody saying don't fight the Fed anymore. And now nobody talks about valuations. So it's just
Guy Adami says it, Rosie. But quick question for you. In your note, you said discretionary spending in real terms barely expanded in Q2. And you talk about the market recognizing things and not. When we talk about a name like Disney or Starbucks or Nike, they're barely like up. They're unchanged on the year. The market is recognizing, I think, the fact that you're like kind of putting out here about discretionary spending. Will a recession be started by a consumer slowdown, even with the backdrop of the jobs picture, which seems kind of confounding? Or might it start from something on the enterprise level?
I think it's going to start at the consumer level, and I think that we'll see the first signs of this after the student loan forgiveness program ends in the coming month. And so I think that it's going to be consumer led. I understand that the frustration amongst the bears, and I've been on this show before, and the question is, where's this recession already? Where's this recession already? But the thing is that interest rates do work their way through long lags. And what's happened this year, 100% true, we've had tremendous fiscal stimulus.
Yeah, I have one word for everybody watching this right now. One word, okay? Patience. Patience. Both sides get very impatient on these things, right? The bears, have been wanting this epic crash to happen, this recession, waiting, right? They had a huge one last year in terms of obviously a huge market drop, right? Not as many participated in that. And then they started short and heavy toward the end of the year, going into this year, thinking it was going to be ugly. And then obviously it's been anything but ugly, right? It's been beautiful this year. And, it's just very impatient. The Fed lags. I just told you guys, it takes 1 to 3 years for this to really start to hit the markets and hit the economy. And so, we're about 18 months in now at this point in time. This should eventually happen, but, it could still be another 18 months. That's the thing. Fed lags. This takes a while to actually hit, right? And so everybody wants this to happen. The bulls wanted to get it over with, right? Can we just have the recession so we can buy the dip and, get on with our lives and have the next multi-year bull cycle? So both sides are getting very impatient. They just want it to happen now. We got to let some time play out here, folks, okay? Let the story develop a little bit, and everything will end up playing out over time. It's just let the game play out a little bit here, okay? You don't want to get impatient on this stuff.
But that's going to term out before the end of the year. What's not going to go away are the lags from these interest rate increases. And even if John Williams says, well, rates will come down next year, the question is by how much? The economy hasn't reset yet. And I did this work looking back historically. Only a handful of times has the Fed raised the funds rate 500 basis points or more in less than a year and a half. I mean, this is a significant rate shock, and we haven't seen the full impact yet. But what I'm going to tell you is that after the 500th basis point increase in the funds rate, and it hasn't happened that often, okay, it's 6 months till the recession. And in that 6 month period, we're in purgatory. We don't know where we are. We're just asking questions. Where's the recession? But unless you believe interest rates don't matter in the most credit sensitive economy in modern history, or you believe the business cycle somehow been repealed because we've had a year where fiscal policy did have an impact, it is not going to be big enough to offset the lags from these interest rate increases. Mm-hmm. So I think that by the third or fourth quarter, we're going to start to see more evidence, but it's going to come out of the consumer side. Not the corporate side, but there will be spin-off effects. But this is going to be
so that's where I disagree with this gentleman, okay? I don't necessarily think you're going to see it in the third and fourth quarter. I think there's more of a potential you could see it in the first quarter and second quarter of 24. But I wouldn't be surprised if actually retail sales pick up over the next several months. And, everybody's expecting retail sales to just get worse and worse. I wouldn't be surprised at all if retail sales actually pick up over the next several months, which is going to add even more confusion and panic in the market because people are saying, wait a minute, there is going to be no recession. The consumer is picking up. We got retail sales starting to accelerate here. What is going on? This can't be. What in the world? I wouldn't be surprised if it's actually a decent holiday shopping season this year. And then you start to see a bigger slowdown in 24. So, that's one of those things. Patience. Everybody wants I want the signs right now. I want the consumer not to buy anything right now. Patience on these things, okay? So, yeah, I wouldn't be surprised at all if actually the next 2 quarters are decent for retail sales.
The recession, I think, will ultimately be more severe than people think into 2024.
So the gentleman, in my opinion, brought up a lot of good points. Obviously, I a little disagree with him on maybe the timing of it, but yeah, I think he brings up some very fair points. All right, next one up here. We still expect recession later this year or early 2024.
It says investors should avoid big tech and focus instead on international stocks. For more on the markets, let's bring in Jeff Klingelhofer, the co-head of investments and portfolio manager at Thornburg Investment Management, which has about $42 billion in assets under management. Jeff, great to have you with us. We were just talking about yesterday's market action. What was so notable about that big gain in yesterday? That was on the back of a decline in Apple, a flat performance in Microsoft. So the big cap tech stocks continue to sort of sit on the sidelines here. Is that why you've gotten a little bit more cautious on this rally?
I think a lot of things, right? We're watching the consumer weaken. We're watching really just the economic cycle play out almost exactly how you would expect it, just over a lengthened time frame. On the back of that, we've seen positive earnings thus far. We've been surprised at the resilience of companies' ability to pass through those increased prices to the end consumer and their ability to support them. But as stocks have rallied, we've pulled back a little bit as we still expect a recession in either the late part of this year or probably more likely the early part of 2024.
Mm-hmm. I'm sure you saw the Moody's downgrade of U.S. banks this morning, and they highlighted sort of what the second quarter results showed in terms of the quality of the asset book they have, but also the headwinds that they could see even more with the commercial real estate portfolio, especially as we head into what they expect a mild recession in 2024. Do you agree with this call? Do you think that's a source of concern for these markets?
I mean, as always, it's a little bit on the late side, right? But we've been watching this for quite some time. But it's 100% accurate in the sense that as the economy continues to shrink and everyone knows about the challenges within the commercial real estate side, it is going to be a challenge, especially for the smaller sized banks. But on the flip side of that, what we've seen through this earnings season is as the consumer continues to hang in, many of the large banks are actually outperforming. Provisions for losses continue to be a little bit lower than we would have expected. And you're really setting a dichotomy up between the smaller banks within the U.S. versus the larger banks within the U.S. So we continue to focus on the more defensive sides of the banking sector and prefer to play the large money sector places.
Do you think that most of the troubles within the smaller to mid-sized cap banks, the ones that were really the focus of this downgrade, we've seen the worst of it, or do you think that's another shoe to drop?
I think there may be another shoe to drop just as we continue to see the realized challenges come into the CRE space. But I think many investors have already expected it. So maybe from a sentiment perspective, I would suggest that we're past the worst of it. From a downgrade perspective, there's probably a little bit more to come.
So what triggers the consumer to actually fall out of bed? I mean, we've seen the consumer hang in, even though inflation's high. Inflation's starting to roll over now. So what is it at this point?
I'd say it's not so much inflation. We have to look through that one level deeper, right? As we've seen the consumer, it's been incredibly strong. One thing we're watching in particular is that roll rate from 30 days delinquent to 60 days delinquent. That's the transition from, gosh, I forgot to make a payment on my credit card to I can't make a payment on my credit card. So we're watching the latter half of this year. Again, companies have had an incredible resiliency, the ability to pass through those increased prices and the consumer's ability to continue to absorb those prices. But as student loan payments come on in the back half of this year, as well as just general levels of employment fall, we're seeing companies pull back on their hiring plans. And that will feed through to the consumer much more than inflation has year to date.
We were chatting a little bit during the break, talking about how you, along with so many others, had come into the year much more pessimistic. Things actually turned out better. The consumer actually hung in, which is a huge force in the market as well. Are you worried that at this point, you're getting more negative and that maybe things will actually hold on? Because, I mean, markets tend to have much more momentum. When they're in this sort of phase, they play out. It's like a pendulum, right? It usually swings.
Yeah, one of the things that's not talked about enough, and sometimes you got to break down the economy to very simple, basic kind of principles, what's going on out there, and look at it from more of like, let's call it more of like a dumbed down version, I guess you can say, right? Because sometimes, people bring up, if they're 30 days delinquent, 60 days delinquent, like all these, more sophisticated ways of looking at the economy and finance and things like that, and that's fine. Sometimes you got to break it down a little simpler than that, okay? We got a lot of construction going on in this country right now. I know in my city, Vegas, the whole damn city's under construction, right? And most of these construction projects were started under a time period when it was very easy to get capital and very easy to get cheap capital, right? And so what I've seen over the past several years is massive amounts of apartments being built and new resorts being built and hotels and all this different stuff, right? New warehouses being built, right? Restaurants, all this stuff. Well, the problem is now, obviously, it's not as easy to get all that money, and the interest rates are so dang high. So the problem is, where are all the projects going to come for in 2024, in 2025, right? Because the projects that are being built right now, these were projects that, started getting set up at the beginning of 2022, in 2021, right? Because whenever you're talking about a bigger construction type project, like that's a huge lead time. So the question is, if you have a major slowdown in construction, where does that lead the economy, right? If those workers don't have the next big warehouse to build, the next big resort to build, the next big apartment complex to build, the next massive amount of homes to build, well, then they're out of work. And then the dominoes start falling in the economy, and then, things start getting ugly pretty dang fast, right? And so I think this is just a factor, and it's taken time to play out because there's so many projects that were started in 2021, 2022 specifically, and those projects are, basically getting finished up this year and over the next 6 months. And the question is, do all those workers have that next big project to build, or do they not? And I think that's just an important factor that I don't think enough people are considering. That's a very base level thing that's extremely important.
To the extreme, we may have more to go on this momentum here.
We always could. That's absolutely true. And while we are turning a little bit more bearish just broadly as we see that playbook just play out, right? We're seeing banks broadly pull back on their lending. We're seeing overall loans increase, particularly within the subprime consumer. We're seeing all of the signs that point to a recession. They're just playing out over a much longer time frame than we expected. But I'd say while we're bearish and we're cautious, there's still some pretty interesting things to do within these markets, right? You can look towards the international side, where valuations are much less expensive than they are here in the U.S., as well as focus on some more of the defensive areas within the U.S. broadly.
You like Yum China, which is a play on the Chinese consumer, and I'm wondering if you're concerned about the Chinese consumer because they're having trouble. Youth unemployment is at a record high. They're not getting the stimulus that so many people had expected, and that really gets to the Yum China consumer.
I think that's exactly right, but we have to keep in mind this is a decades-long story. So the thesis for us has always been that Yum China has the ability to more than double its store count over the coming 10 or even 15 years. So yes, absolutely, we're watching that portion of the space. We're watching that consumer in particular, and they are challenged in today's environment. But looking over the longer term, we do expect additional stimulus. And much like the pendulum swings here in the U.S., the pendulum can absolutely swing within the Chinese space.
Are you also looking at Chinese tech? Because those valuations are much lower than U.S. tech.
They are. I would say by and large, no, we're avoiding much of that space, but we are looking at global tech a little bit more than U.S. tech, right? What we want to stay away from in particular is those AI stories. We view AI as more likely an evolution, not a step change, but there's a number of companies that benefit from broadly just the continued move within the chip space is one area that we like.
Yeah, so definitely disagree with him in terms of looking for international tech, okay? What are we talking about here? No, you want to buy the C-grade performers, you want to buy the C-grade companies and buy international tech. You want to buy the grade A performers and buy U.S. tech. Like, you're talking about the first round draft picks versus the last round draft picks here, okay? Like, what are we talking about here? Like, that's ridiculous. And, yeah, China has a whole set of problems. Obviously, if the U.S. was to weaken significantly for any reason, let's say next year, it's going to hit China even more, which is kind of a scary thing for what could potentially happen with youth unemployment in China in general, right? And everything has been going on there. So very interesting time in regards to that. There's a potential they could bottom and come out of that. It's very interesting. If you look back at the great financial crisis, it seemed like China had issues prior to the U.S. having issues, and it seemed like China was really on kind of just a really nice, they kind of seemed like the one bright spot. While the U.S. was getting devastated by the great financial crisis, it seemed like everything was just fine and dandy in China. I remember the Beijing Olympics in 2008 in China, and it just seemed like China was the one bright spot in the world. But now it looks like China is a very weak spot, and it looks like the U.S. is the one really, really super bright spot. So it'd be interesting to see if that changes over time here. But, it certainly can make sense to, if you're not hedged at all, hedge a little bit, hold a little cash around because, you could actually get really good money on your cash right now too. So do keep that in mind. Have some cash on a savings account, getting yourself 4 to 5%. If you want to buy some treasuries, that are dated out 3 months, 6 months, you can get really good returns on those right now. And, let's see how this whole game plays out. There's a few select stocks that are really great deals right now in the market. It makes a lot of sense to be a buyer of, but it's not the whole market in general. So especially with the risk factors out there. I appreciate everybody joining me as always. Thanks so much for being subscribed, folks. 33,000 plus subscribers on the channel. If you want to say hello to me, you enjoy the channel, say hello on Instagram. There'll be pinned comment down there. Much love and have a great day.